We're going to pick up chapter 13, excuse me, 16, and start to talk about scenarios, which is really the more common scenario, where we have more than one product or more than one product line. So what we had talked about in the last video is single product situation. Now, if we have multiple products, quite often there may be certain processes or even labor that might be associated with more than one product line, and then at some point they diverge and they become, their own separate products. So we will have direct fixed expenses, which is what is strictly applicable to the individual product, but then we will also have common fixed expenses that we would have those even if we lopped off one of our segments or products. So when we're looking at a multiple product analysis, we have to figure out what combination of these products at what volume will allow us to hit that break-even point. So it isn't just that it's the number of products overall, because the costs associated with those are different and probably the price that we sell them for are different. And so we have to determine how we balance the overall production of multiple products to make sure that we hit our break even or our target profits. So we've got now the Blazin' Boards company again, and they're going to sell 10,000 regular snowboards and 2,500 of the deluxe snowboards in the coming year. Regulars are 400 and deluxe are 600, and the variable cost per unit on the regular is 240 and the deluxe is 300, and then we have their direct fixed costs there. Now there are common fixed and administrative costs of 550,000. So again, these costs would remain if we decided, for example, we were only going to make the regular and not the deluxe, because we need these common costs for the company to run. All right, so we're going to use a product mix formula. And we need to, again, look at whole numbers for products. We can't manufacture part of a product. And we will look at a blended approach for how we are going to do this. So we've got our sales mix of the regular to the deluxe, 10,000 to 25,000. In other words, it's a 4-to-1. So just going back to look at our given information here, they're going to sell 10,000 regular, 2,500 deluxe, and so for basically for every one deluxe, they will sell 4 of the regular. So now we look at what portion of the contribution is made by each unit. So we've got our regular that is $400 a unit. We've got the unit variable costs of $240. And then after we've covered our costs, there is $160 left per unit that can be contributed to overhead. And again, we're going to do 4 of the regular for every 1 of the deluxe. So we take the unit contribution margin and we multiply that by the sales mix. We do the same thing on both of those and then add those together. And so in sum, this will give us a contribution sales mix of $940. So now at this 4-to-1 sales ratio of the regular to the, I don't know, was it deluxe or the super duper, we need to figure out how we break even. How many of those gets us at the break even point? So we take the total costs of the regular plus the deluxe plus our common costs, add those together and divide those by the 940, which is the the mix of the contribution margin between the two products. And this tells us that our break even for regular snowboard is, because we're going to again do 4 to every one of the others, it's 5,745 regular snowboards and 1,436 of the fancy snowboards. So now we're going to take a look at our income statement and we're going to prove that we're right. We take the break-even number for each of those and we multiply those times the selling price, which was 400 and 600 respectively. And so that is our sales of the two different models, then totaled together. We've subtracted out the variable expenses to get our contribution margin, and then our direct fixed expenses. Then that gives us the product margin, and then from that we subtract the common expenses, and that gets us to 0, which proves in fact that we have made no money at this sales level. Now we can also look at this. What we had just done was from a break-even point from a units produced, or units sold I should say, standpoint, but we can also look at it again from the sales revenue standpoint. Besides just doing these calculations, that's not the only way that you can look at this sales mix combination. You can do the analysis based on graphical stuff, and you can actually do it in Excel, and it's kind of cool. But if we were going to graph this out, we would, and we have the data supplied to us by the Gordon Company that will assist us in doing this. So we've got our total fixed costs plus, we've got our variable cost per unit and our selling price per unit. And so let us graph this out. So again, our operating income equals selling price times the number of units, and we would subtract from that our variable costs and our fixed costs as well. So our operating income from a graphical standpoint would be the dependent variable, and then the number of units produced is the independent variable. Now this is a pretty rudimentary graph here, but what this illustrates is, now we've got our fixed costs of $100 down here, and what this essentially says is if we sell nothing, we still had to pay our fixed costs, so we're actually in the hole by $100. Now what do we have to do to reach a point where we make $0? And what this graph tells us is that we have to sell 20 units just to cover our fixed costs. So at $5 a unit, which is what they told us it was, that makes sense. 5 times 20 is $100. So that covers our fixed costs and leaves us at nothing. So now we want to make something in terms of profits. And our target here is $100. And so this makes sense again that at $40 per unit, 5 units, or $5, 40 units at $5 per unit gets us at $200. We subtract our fixed costs and we're left with a profit of $100 at that sales volume. And we could continue to follow this up. Now, in order to really get the relationship between the costs and the profits, we would want to graph both of these lines separately. And so here we do that. And so we've got the total cost line and the total graph line. I mean, the total cost line and the total revenue line. The point at which those two intersect is our break-even point. Below the point at which they intersect, that's where we're losing money. Above the point that they intersect, that's when we start to make money. Looking at that is often a way that folks without a lot of knowledge, if you're doing a presentation and you want to explain this to the non-money people in the company, these graphs can be really effective to illustrate that. Now, the whole CVP process requires certain assumptions. First of all, it assumes that there's a linear relationship between your costs and your production. That's not always the case. You certainly reach a point where your fixed costs can only produce so many, and then your fixed costs have to go up. Um, so that has to be addressed once you reach a certain volume. This also assumes that we can predict the sales mix between two products. So with our snowboard example, we assumed 4 regular snowboards for every one of the deluxe, and we need to be able to have that data to be able to accurately make those assumptions in advance in order to have this calculation be accurate, because again, this is kind of a forecasting situation. Once we've done it, we know historically, but that doesn't always help us for planning purposes. So now you're in management, you recognize that there are certain assumptions that you have to make, and those may not be reliable. I mean, again, it's your best business judgment in this product mix situation or the number of sales. So there are some strategies that management can engage in to hedge your bets a little bit. To consider widening the idea of break even beyond just a single target point. So to have kind of a band instead. To also use sensitivity analysis or what if scenarios, which I'll talk about in a minute. And then we can measure risk and address risk through operating leverage and margin of safety. Now, our margin of safety is basically what we produce above our break-even point. It's, the distance between what we're producing and the point at which we start losing money, and that is our margin of safety. And the degree to which we can increase our margin of safety, even if all of our assumptions don't hold true, it allows us some breathing space, a bit of a cushion, if you will, before we fall below that break even into the losing profits. We can also address this through operating leverage, which is essentially using fixed costs and trying to alter our fixed costs in order to increase the margins on our products. If we can't sell more and it costs us whatever it is to produce them, perhaps doing something with our fixed costs may be possible to then increase profits in that way. Sensitivity analyses are really important because, as with the snowboard example, we had this 4-to-1 mix. Well, what if we're wrong? What if we manufacture zero, or not manufacture, excuse me, sell 0 of the deluxe snowboards? At what point, how many regular snowboards can we realistically plan on selling that will compensate for that? Do we believe that we can sell enough if it turns out that we sell 0 of the deluxe? So you can look at these from both kind of a pie in the sky analysis of this is all great and this is what we could realize if our wildest dreams came true, but by the other hand, you still need to look at potentially your doomsday scenario and how bad could our sales become before we cross over that break-even point into losses. So if you have done the analysis at both ends of the spectrum and you've developed strategies to address everything in between, hopefully in terms of management, you're not caught off guard if your assumptions, and they probably won't, land exactly spot on in the way that you had predicted them to. So, So management could and should be running what if scenarios. You shouldn't just pick a set of assumptions and then put all your eggs in that basket. From a management perspective, you should be looking at a continuum. And you run one set of calculations, perhaps using a pie in the sky sales mix representation, and then you run another one using your doomsday scenario. And what management strategies can you employ in between? Hopefully, well, hopefully the doomsday scenario won't come true, but probably the pie in the sky won't either. So how, as management, do you respond to what happens in between? And how close do you have to get to that doomsday scenario before you start losing money? And so the sensitivity analysis allows you to understand um, where that the parameters of your profitability spectrum are. And uh, we can also incorporate activity-based costing in this cost volume profit analysis. And what we would do is incorporate the use of drivers, cost drivers in this. So you can see here, we've got, number of setups, number of engineering hours, things like that, which we can use to come up with our break-even point, as well as our target income. And I won't sort of break these calculations down because I think they're reasonably self-explanatory, but what this does is it actually drills down and gives you a much richer analysis. It's more work, absolutely, to incorporate the activity-based costing into it. And this is a point at which management has to decide, how much is this data worth? If it costs us in terms of what it takes to get the calculation, if it costs us too much, then having all the data in the world doesn't make sense if what it cost us to get the data eats away at our profits. So finding a good balance between tracking every paperclip, and making sure that profits stay within the targeted range. You can also use the CVP analysis with not-for-profits. So you could be looking at it from the concept of service delivery and different programs. And so it isn't just that we're looking at it from a product standpoint. Service companies could do it as well. And presumably they're doing different volumes of service and perhaps have lower level staff that are billed out at a different rate doing certain services, and professional staff billing out at a different rate. So you can use those sales mixes to try and figure out where optimal profits can be made. And that concludes chapter 16. We're almost done.